Hi everyone, this is Rob Roy, and welcome to the Elliott Wave Options U.S. Market Update. As we do each and every week, we show you on your screen the stocks that will be featured in this recording. And if there's a particular stock you're interested in, you can go directly to it using the chapters feature in this recording. All right, let's get to the markets. By now, you're aware of what happened with the Federal Reserve yesterday. We'll talk a little bit more about that when we get to the bond market. But as far as how the equities market has reacted, last week we talked about, could there be a big spike up? Could this be the beginning of a correction? Perhaps both of those are still possible. I don't think the Fed gave enough for the big FOMO spike that I thought could happen. And certainly the market has been ho-hum about it. And as a quick reminder, we are recording this during market hours on Friday, so the closing prices could be slightly different, but it's a big yawner so far today on Friday, and really not too much that was exciting in yesterday's trade. So we go back to trying to figure out, where do we go from here? That's what a lot of you have been asking, which is a great question. What happens now? We've continued up in this ascending pennant pattern we've been in for a while. We had resistance right in this area, right under 650, that the market hung in there for a while. And then we talked, if we broke that, the AI at Hub. And by the way, a quick mention, if you haven't gotten a copy of the software, you can get it at hubb.com. It's completely free. The Elliott Wave signals are free. They're not my Elliott Wave labels. They're right from the algorithm that Ralph Nelson Elliott wrote. You do have an opportunity to subscribe to these AI signals if you'd like, but the software in the Elliott Wave is free. So there was a 62% chance from the AI of hitting 652. We got there, and then we drifted higher. So once we broke 652, that's when you guys said, all right, we hit that target. What's next? And I drew this zigzag pattern here. If you've been watching for a while, you know I love the zigzag patterns, particularly within wave threes, the strongest of all waves. So higher percentage chance the zigzag's going to work. They work a lot of the time on their own anyway. And when we had a perfect 50% B wave correction, that was going to yield 100% extension, and bam, that's where we've pegged. Even after the Fed meeting, we're just sitting right there at that 100% extension. So brings up the question that I talked about right in the beginning. Where do we go from here now? And the two scenarios that I talked about, I think, are still in play. That wave three is still labeled green, which means by this algorithm, it's an active wave three. We could continue to go higher and perhaps go up and hit that 161.8% fib extension. That's what you look for in a zigzag. Once you reach the targeted expectation, can you go higher? And sometimes you get an extended C wave, especially in the wave three, and it goes up to the 161.8% level. So that's still possible. So up around 675, then we'd have to reassess. Or since we're kind of hanging around this 100% extension, is it trying to tell us that that's it? That's the end of the zigzag. And based on zigzag rules, when a zigzag ends, you retrace the C wave, which could mean a downward move back down to where this B is. So I know you guys want something more specific, but this is what happens in the market sometimes. Sometimes it's best just to be a bit patient and let the market give you its next directional move. And trade then. Nobody gets in at the bottom and out at the top. Just taking a piece out of the middle is how you become successful over time. This is one of those times, I think, that we let a few more trading days play out and see which of those scenarios is going to occur. Again, I didn't get the one I wanted. I wanted a surprise from the Fed, a big FOMO reaction, a big spike up, a bit of a blow off top, and then I think setting up for a correction then would have been an easy setup. But we didn't get that. And we'll have to wait and see. Going to the VIX, I'm talking about, again, what the Fed gave us, which was not a whole lot. It's keeping enough uncertainty here that we're still holding the 15 level, slightly elevated VIX, not significantly so, but higher than the 12.5 that we based at last summer. We're coming out of the summer. A lot of people were concerned about the August-September timeframe, as historically they aren't great times for the market. But nothing works 100% of the time, and really hasn't been that much of a negative this year either. So again, looking at historical norms, calendar norms is another piece of information, but nothing is etched in stone, as they say, as far as where the markets are going to go. We still have this big descending triangle pattern on the VIX. What could spur this to go higher? The Fed didn't give enough to make it negative enough or hawkish enough to create the big spike up, but could something unforeseen come out and create a spike up in the VIX. Remember, a descending triangle does not guarantee a downward breakout. Any triangle can break either direction. The interesting thing is if we break 15, we do have a pretty staunch level of support down there at 12.5. Once again, going back to last summer, not too far to move to the downside. And then we'll see as we move into what is, again, historically a more bullish time of the year. As we get into October, November, we start looking at the holidays, the Black Friday, the seasonal holiday shopping. It's normally a good time for the markets moving into the beginning of spring before we get to tax time down in May. But is that going to not work as well? So it's pretty interesting as far as the historical calendar norms not really playing out as much this year. So if we go to the bond market, which is what I would really want to focus on, we look at TLT, the bond market's reaction to the Fed announcement. And we can put that slide up. The Fed cut 25 basis points pretty much as expected. I asked you guys, do you think there was a chance of 50 basis points in last week's recording? I didn't really think so. I just felt like that would be Chairman Powell and the Fed admitting that they were behind the curve, and I don't think they want to admit that. The jobs market is showing that maybe they should have been cutting a little bit sooner. I didn't think we'd get that 50 basis point cut for those reasons. But the thing moving forward is what's interesting. You can see it hints at a couple more rate cuts, and the market has priced in 75 basis points of rate cuts by the end of the year. But the dot plot is all over the place, which is where the voting members of the FOMC put where their forecasts are, where they think things may go. And it's kind of like the Fed's playing the flat line. There was actually dissenter that favored no cut in the meeting. And then we had President Trump's new appointee that was saying he'd like to see 5 more cuts. So you had two extremes there. But the average is kind of in the middle. And Chairman Powell's statement at the end was, we're going to be data dependent. So we went right back to their old mantra. We're going to be data dependent. We're going to take it meeting by meeting. So there was no commitment for where things are going to go. No real overly dovish or hawkish sound. So here we are back to figuring out what goes on from here. So let's get back to the chart of TLT. And we had talked about this with the breakout from the triangle. And going back, if you're new to the viewership, I've been showing this for a while. Well, the bond market tends to have a lot of really smart people in it. There's more money in the bond market than the equities market. So it's good to take a cue from the bond market when you're an equities trader or derivatives, as we are at ewotrader.com, trading options on equities. The bond market was pretty unsure of what was going to happen with rates. You had 4 of these symmetrical triangles. The only real movement that came out of TLT, which is prices on the 20-year, prices and yields move inversely. So when you see the price bars, that tells you rates went the other way. That was the breakouts. The breakouts from the triangles were really the only movements, and then they would get consolidated again. And basically, we went nowhere for the entire year here. So we have not steepened the yield curve enough to where you would think, okay, the economy is getting stronger and we're moving in the right direction. We just have a fair economy. It's not bad, but it's not great either. And then the breakout that occurred, it seemed that the bond market was, just in case we get the 50 basis points, pricing in this big spike up and movement down in rates. Well, they didn't get it. So what happens? The correction comes right back down, following right along the rules that we talk about so often. No security in any time frame gets too far from the 10-day moving average, and when it goes vertically up, oftentimes comes vertically back down. So we had this vertical move up, we had the separation of the 10-day moving average, and so here we are coming right back down. Now, will the bond market kind of hover at these lower rates? That seems to make sense. The market doesn't always do what makes sense, but you can make an argument that we're probably going to consolidate at a little higher level, perhaps come back down and test the point of the triangle. That happens a lot with triangle breakouts, but maybe not. We might just go into a trading range a little bit higher here. So be really interesting to watch that. I know a lot of you like the 10-year, so let's go look at that a little bit on the shorter end of the yield curve. And TNX does show rates. So this is showing rates here, and you can see a little bit of a tick up. So once again, rates ticked up a little bit on the longer end, picked up a little bit on the shorter end, but nothing too significant. But the 10-year had also broken down in rates in anticipation of that meeting. So I found that interesting that the bond market was unsure enough that they were at least giving a little bit of preparation for the fact that maybe we could have had a little more dovish announcement this week than what we ended up getting. So pretty interesting stuff as we go through and look at what's occurring in the markets. All right, so let's get back and look at the dollar. That's one I've been talking about quite a bit. When we take a look at the chart of the dollar, I was a little bit concerned when we broke below this 97.5. If you've been watching a lot, thank you. And you're aware that I've called this channel the Goldilocks channel, having the dollar down in this area. So it's lower, helps companies with international exposure with the exchange rate, et cetera. It's kind of a helps keep a bid under the equities market, but I didn't want to see the dollar break down. And we did come low enough the day before the Fed meeting to move that wave 5 from here. That was the July low. And my point had been, I think it'd be okay to test that level. I didn't want to see it break down and come down here into the lower level where the wave 5 tap box is. That stands for time and price projection. That gets us down to 90. And the reason that support line is drawn there is if you look at a monthly chart of the dollar, you can see that 90 has been the low in the past. So try to show you that chart real quick, and you can see the times that we've been down here going back to 2018, 2021. Do we go back down there again? We're kind of in no man's land right here. I'd prefer to hang around this 97 half level, but you can see that there's not a lot on the longer term monthly chart to support that. So the potential is for the dollar to go down lower, perhaps into this wave 5 tap box. That would concern me a bit on the equity side, because I do think that you're going to hear all kind of whispers of the dollar's breaking down. Are foreign countries going to continue to hold their mass reserves of U.S. dollars? Is it the currency of last resort? And all those kind of comments, and then there'll be some concerns about it. And I just don't think, again, that'll be positive for equities. So I prefer not to see it, but the market doesn't care what I prefer. For now, we bounce back up, testing the 10-day moving average, and maybe we get back into the Goldilocks corridor. I don't know. We'll just have to wait and see how that plays out. But it was a little bit concerning, and had the Fed gone 50 basis points, bam, I think you would have seen some significant follow through there. And perhaps we do start to just drift lower on the dollar as we move into at least the expectation that we're going to get more rate cuts. We just don't know definitively how much we're going to get and what months that they're going to occur. So really, really interesting stuff along those lines. And if we take a look at gold, so we'll go take a look at gold real quick, and then we'll come back and look at the rest of the U.S. market updates, or the U.S. market charts, if you will. The AI nailed gold. We had a trade on this triangle here. Gold loves to do that. It loves to consolidate, consolidate, breakout. And then based on the triangle rules, mouth of the triangle from the point, we could have gone down to 290 on a downward breakout up to 330. That's where we exited. And then the AI came out and says, I think we're going to go a little higher, 70% chance we hit 337. And that's exactly where we went. The AI nailed this one as well, just as it did silver. So we're consolidating here. Does the metals market need to have a little bit of backing and filling, or do we take off? The metals will follow what the dollar does. So if the dollar drifts down, I think you see metals drift back a little bit higher, maybe after some consolidation of these breakout moves. And then there's SLV. We've talked about this 5-wave pattern. It's been in, had a smaller, much smaller triangle in GLD. It broke out, following along, staying above the 10-day moving average. It's in its tap box, though, so it seems to think that maybe we do get some consolidation here. There's a little more room for that wave 5 to drift higher, but it is labeled. We'll see how that works and plays out as we move forward as well. Another thing I wanted to show you, I want to go back to the chart of the SPY. And in this week's TradeFinder, and by the way, if you haven't signed up for TradeFinder, you can do it with the link on your screen. You can go to ewotrader.com and sign up there. We do it every Tuesday at 1 p.m. Eastern time. It's during market hours. We look at the markets, we look for trade ideas, and we have a live Q&A. Great community of people. Love to have you join. Great social media aspect to the platform as well. That's highlighted during that meeting. So love to have you sign up there and join us on Tuesday at 1 o'clock. Well, in this week's TradeFinder, I had mentioned that it might be prudent to have some puts on the SPY, especially if you got a lot of long positions, just in case the Fed disappoints, just as a protective measure, good diversification, etc. And then, let's see how the markets react. And again, we don't know yet, but I still think having a little protection in the portfolio with some of the valuations, what seems to be occurring in the market is market rotation rather than any sort of a significant correction, at least so far. And so if we start looking at diversification, we can look at the Dow and notice that the DIA is labeled a wave 5. We've been talking about this for the last couple of weeks. The SPY is in a wave 3, but the DIA is in a wave 5. The patterns are similar. Happens oftentimes that the patterns can be a little bit different, but normally the labeling is fairly close. And you could see, and some have opined, which would agree with, that this wave 5 could be over and we start to correct back down. And that could coincide with a wave 4 correction in the SPY. Again, even though the patterns aren't labeled the same, they could be moving the same direction. We'll see. But if the market moves higher, does that wave 3 on the DIA, or does that wave 5 go to a wave 3 on the DIA? I think the market rotation, barring any sort of a correction next week, could materialize. And so we've got a wave 3 on the SPY, a wave 5 on the DIA. We go to the Qs, and the Qs have a wave 3 as well. The Mag 7 trade is still in play. Still looking at the big tech stocks, but even this morning on the financial networks, there's a lot of people that are concerned about valuations. How much longer can that trade carry the markets? And there's other people that I think feel the same way I do, that rotation is going to be key. So stock specific, find where the money is moving rather than big, massive moves in the market itself. Individual stocks, individual sectors will be taking the mantra, and it may very well be sectors other than the Mag 7, the big tech stocks that have been moving. But for now, wave 3 staying above the 10-day moving average, moving higher. Nothing from a technical standpoint that says that's going to change, but at some point in time, it seems like that move would weaken a little bit. And then we go to an area where a lot of people are looking at now. There's a lot of speculation that maybe some of that market rotation goes into the small caps. So here's the IWM. It's in a wave 5. So we have the SPY and the Qs in a wave 3 labeled right now, and we have the IWM and the DIA in a wave 5. So do these two relabel? Could that be an indication of that market rotation? Money moves into the Dow, that 5 turns to a 3. Money moves into small caps. So kind of on the two opposites. You go some money on the big side, some money on the small side, and then these two 5s relabeled to 3s to meet the SPY and the Qs. That could very well happen as well. But you can see this looks awfully intriguing here on the IWM, but we're already at 110% extension. So either the views that money could rotate into small caps now is wrong, or we do have the likelihood that that 5 relabels to a 3. I think that could very well happen. Let's move to the crypto space, at least as evidenced by BITB. It's one of the two main ETFs we talk about. A lot of you like IBIT. Both of them have very liquid options. IBIT does have weeklies if you like shorter term stuff. The BITB does not, but the monthly options are super liquid. And we're just kind of trending up. We had a little bit of a move up yesterday. I think if the Fed had been a little more dovish, we might have seen even more follow through there to the upside, pulling back a little bit. I know it trades 24/7, but it does give a calendar rollover for end of day charting programs. And so at least for now, we've backed off, but staying above the 10-day moving average. We have a big zigzag here on BITB, which shows that we could be moving much higher in that C wave and perhaps just a slow, steady move higher rather than the big takeoff. We didn't get that FOMO spike on the S&P, so we didn't get it on the cryptos either, but still looking pretty bullish on that chart there. And then Ethereum, we've talked about the stair-step pattern that it's had where we went vertically up, horizontal consolidation, vertical, horizontal, vertical. But this time we went into a triangle on the consolidation, but really no significant breakout yet. But once again, triangles break primarily one of 3 ways. You break out and take off, you break out, come back and test the point of the breakout, or you have a false breakout and you still could go lower, that the big move is actually the downside, that the first move is just a head fake. That's still a possibility. Or it could just be we're testing the point and it starts to drift higher, like the chart of Bitcoin. So they could be kind of considered to be a little bit more in lockstep now, where there was a period of time where Ethereum was really outperforming Bitcoin, but now they seem to be back on the same page, if you will, at this point. Looking at energy, UNG, every time it looks like it wants to make a run, it comes back down. Frustrating if you want to be long the UNG. And I drew this line here at 15. The wave 5 extended more than 100%. You've heard me opine on all this. I'm not going to do it. Go back and watch one of the previous recordings where I go through the supply demand analysis of why, even with increased demand coming, the administration being not fans of solar or wind power, we don't have the electrical grid for all these new data centers that are going to be built, going to go to natural gas. But so far, there's not enough certainty that that's going to be enough of a demand to outtake the supply that we have. We have the Middle East and natural gas here in the U.S. So still just kind of hanging around this lower line. And I'm not looking for any sort of a big move higher. We are moving into the winter time. The Farmer's Almanac showed that going to be a lot colder winter than normal in some areas of the country. Maybe that finally gives the bid. Maybe we have to have the first big snowstorm come in a little bit early or something along those lines. But I'm not looking for some sort of a big demand-based run. I think it's going to take a while for those data centers to get built and to find out how much natural gas they're really going to use. I'm just looking for the fact that UNG has been sold into for so long. At some point, the sellers get exhausted and you get a reflex bounce. And that's it. And that's why I drew that line at resistance at 15. So just looking for a little bit of a reflex bounce. And a couple times it looked like, all right, we're on our way. And then right back down to support at 12.5. Oil, again, Q Led Zeppelin, song remains the same. Same thing. I've given my criteria on this. This is where OPEC is happy with the price. They're doing a pretty darn good job of managing supply demand there, keeping the price of oil elevated, but not so high that it runs people into electric vehicles and hurts the demand part of the supply demand curve. And so here we sit, still pegged at 75. We do have a triangle here, so maybe there is going to be some sort of a breakout in oil, and we'll have to wait and see. But for now, not much else to say that we haven't said over the last several weeks on the price of oil. Now let's move to stocks of interest. And as we look at, y'all asked for SMCI, and I wanted to add a big thank you. We did finally hit that official 50,000 subscriber milestone last week. Thank you so much. Appreciate that. Hit that like button and let's keep pushing. Let's keep going higher. So if you haven't subscribed, hit the subscribe button. Recommend this to other people that you think might enjoy these videos. And now we're going to talk about the giveaway that we normally do. All you have to do is leave a comment under this video and you're registered for this free giveaway of our level 3 subscriptions, which includes time strategy, which is a sideways income-based strategy, the volatility strategy, which is breakouts, unique way of doing strangles on all the triangle patterns. And then we have the AI-based impulse, which is directional trades, primarily focused on those zigzags within the wave 3. It's worth thousands of dollars, and you can get it all for free. A lot of you took advantage of the Top Shot offer, which was a special thing that we did for hitting this 50,000 milestone. So once again, thanks for that. But now we're back to regular programming here. So leave a comment under the video. You're registered for that giveaway. But let's take a look at the chart at SMCI. I read every one of your comments. I answer as many as I can, time and travel permitted. But you can see, looking at SMCI, I'm actually, this is on my personal watch list as well. You can draw this support line here wherever you want. If you want it right there, you like it better down there around 40. We're trying to get a 1030 bullish cross here where the 10-day is the lime green line, breaks above the fuchsia colored line. The 50-day moving average is right here. It is another little bit level of resistance. But if we can put some distance between 45 here, and the stock price, I think we could see a quick run to 50 or 55, which is the next two levels that will extend. So I think this chart looks constructively interesting here. I just want to see, the Missouri show me the breakout of this 45 level. And if we hold today, do we get the follow through day on Monday? Then I think that could be a place to look. as obviously SMCI has not followed the other big tech stocks following all their accounting issues, etc. But I think this is becoming quite interesting here. I did want to show Mara, going back to the crypto space, a miner. Some of the AI signals have shown some ETFs that have miners in them. I know a lot of you like this, so I thought I'd just show you this one. A little bit of resistance up there at 20. The AI gave it a 54% chance of hitting that level, just barely more than a toss of a coin. But we had a really nice long consolidation here. I used to call that the launch pad. Still do call it that, but I was raised on the Space Coast. My parents were involved in the space program. And so when you get one of these real sideways consolidations, oftentimes you get a blast off from the launch pad. And that's what Mara looks to be doing. Nice move yesterday. We'll see what happens when it gets up to 20. The AI had called that back in July that we'd get up to that level. We got there, came back down to support. Now, can we do it again and push through that 20 level this time? I think if the crypto space does continue to bleed higher, then that very well could occur. Looking at Tesla, a lot of questions coming back and TradeFinder on Tesla again. And we nailed this one. We got this one pretty spot on. It talked about this ascending triangle pattern here. People were itching to get in when we were right here at 350. And it's like, let's let it break that 350 level. And if it does, we're probably going to go to 400 rather quickly. That's exactly what happened. That was spot on. And I was surprised that we blasted right through that. I thought 400 might act as a little resistance, one of those big round numbers, but we've pushed right through that level. 67% chance from the AI that we make it up here just under the 450 level at, call it 441. We're almost there. So then what happens from there? We're starting to get close, not quite close enough to get into the tractor beam effect of moving up to 500. This is a bit of a short covering rally that occurred here. So let's be honest on that. We talked about that last week where, or the week before, an announcement came out that there was more short interest, I think, than in history of Tesla. And that's all you needed. Heavy short interest, bam, scares people out. You get the short covering and you get the rally. And that's what initiated it. But a lot of impulse moves start from short covering rallies. So it doesn't mean that we're done moving up. But I think some more consolidation right in this area here is warranted. And then we'll see if Tesla can break that 450 level. NVIDIA trying to come back a little bit here. And we got to wait for the administration to give NVIDIA the go-ahead on what chips they can actually sell in China. As you know, their guidance included no sales into China. So once that's done, that could put a bid back under NVIDIA. But for me personally, just looking at a chart standpoint, I really want to see it break that 180 level, take out that wave 3 high. The wave 4 is still active, which means we're not sure that that's the bottom. But we did hold the 50-day moving average a couple of times here. We're getting back up above the 10-day moving average. But I think the prudent thing, let's let it break that 180 level and the wave 3, and then maybe we have something happening in NVIDIA. And you could certainly make a case for once they get the go-ahead, what it is. There'll be all kinds of estimates on how much sales NVIDIA could get in China, et cetera. But China is talking about their new chips and pretty proud of them. And even Jensen Huang said, yeah, it's not a bad chip. So that's why I want to say, let's let NVIDIA break that level. Amazon, same type of scenario here, right at the 240 level, right where the wave 3 was. We are drifting up. We're moving up above the 10-day moving average, but there's resistance right there at that wave 3 and wave 5 high. So let's let Amazon get above 240. So I think this one's kind of on watch and see as well. Almost took Apple off, but it is moving higher, even though they really kind of disappointed with their new phones. That got a tick down right when they had their big showcase day where they showed what's new in the iPhone 17, et cetera. It's older technology, but people are just really itching. They want to put a bid underneath Apple, but look where we are. So zigzag right here. The B wave is at the 38.2% level. That gives you a 61.8% expectation. We're there today. So do we go higher? The AI says it is a toss of a coin. 50% chance that we can make it up to 250. Maybe we do, maybe we don't. But the rules of the zigzag that I talked about before, if we go to the next extension, that's a 100% extension because 38.2 gives you a 61.8% expectation. And they happen to coincide right with that potential AI target. So maybe we get a little bit more out of Apple. But again, the zigzag has done what it's supposed to, so we have to have a little bit of caution there. But it is interesting that the extension level is right where the AI target price is. And then Netflix, we'll take a look at Netflix, which seems to be trying to break out of that triangle pattern. It's going to make a big run at some point. But again, you do not pick a direction with triangles. Even Elliott said, ignore the Elliott wave pattern when you have a triangle. Triangles trump everything, and be respectful that it could move either way. Don't get caught picking an upside move. Maybe it does, but when you see a triangle, know that it could go either way. So we'll just keep an eye on Netflix when it breaks out of that triangle, have a better idea there. I did want to show you one last thing as we wrap up on that chart, ORCL, because it bothers one of the rules that I talk about quite often. When you get a vertical move, what goes vertically up can come vertically back down. No security in any time frame, gets too far from the 10-day moving average, at least not for long. And we talk about this during TradeFinder, talk about it with our subscribers during the insiders meeting each week at Ewo Trader, that when you get one of these big moves, there's a fade trade that you can do. It's very short-lived, 1 to 3 days, when you hit so far overbought, and this happened on Oracle's guidance, not their earnings report. You can get a quick retracement trade, and that's why I say it's about 1 to 3 days, and this is a perfect example of it. So we got way overbought, boom, back down for a couple days, and then we've consolidated right there. So something to keep in the back of your mind. Doesn't mean that you're looking for this gap to get filled immediately. Not saying that. It's oftentimes a quick fade opportunity. So thanks again, as always, for watching. Thanks again for hitting that 50,000 milestone. Look forward to talking to you again next week. Take care, everybody. If you like these recordings, I'd like to invite you to join our new TradeFinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.